Deep Dive with David Stendahl, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey there, it's David Stendahl with tonight's Deep Dive. It is October 24th, 2018, and because the equity markets and the S&P did so poorly today, I thought I would take a look at that. So S&P 500, the ETF is SH, which is a short position inverse fund. The trends are all pointing to the downside and have been for a little bit here. The technicals are very weak and have been for a little while, but nothing is showing up here as far as pivots and something to look for as far as a low. So I think it's going to take a little while for the market to really build out a bit of a base. The base that had been forming certainly failed a number of days ago. There's nothing showing up on the deep dive as far as the pro alerts on the daily bar basis, and we are starting to see some early signs here on the weeklies with the day's low having just triggered. But let's take a look at the market and just kind of give you an indication as to what's taking place. Daily bars here in the S&P 500, and we broke through two support levels here today. One right through here at 2707, and then the other one, minor as it is, at 2689. So currently we are below that particular threshold, and we really need to bounce back above there. If we don't, then our next threshold to the downside is right through here at 2613.5. This is this level right through here. On a weekly bar basis, you can see that there's really nothing that's showing up with our signal levels, which are our support and resistance levels. There's nothing that's showing up here. I just want to show this to you. It's kind of hard to see here, but here's a blue magenta dot that we had oversold on weekly bars. Each of these are weekly bars some time ago, and the market did a dip type formation. Here's another one right through here, another dip formation, although volatile, but it had a dip formation. Here's one that is formed here, and we're on the left-hand side of the V, or the left-hand side of the U. So we're still out there seeing as to whether or not the market's going to start to base. Obviously, I thought that the market was going to base a little bit sooner, but this threshold to the downside today leads me to believe that there's still going to be some type of a formation, but the volatility is quite strong, so we'll have to see what does take place, and this is caused by a number of things that the talking heads on TV will talk about, but for our purposes, we'll see as to whether or not the market's going to actually base here. But there is no major support here. The one interesting aspect that is very early, but I do want to show that there is a potential, and I'll probably have to readdress this, but a potential bearish divergence that's going to form. So here's a high, the market sells off, we get a low. So obviously the market is sold off. We get a little surge, we get a lower low on the price action. This on the S&P on daily bars. If we look at our indicator, we see that we have a low here corresponding with the low here in the market. But where we stand right now is if the market were to reverse tomorrow, then we would have the indicator start to base and start to head higher, and it's not going to hit a lower low. So low, low, lower low, higher low, and that's a bullish divergence. So we'll see as we're not the market through this consolidation period that we're going to need, and because we're below that threshold, it had better come soon. Otherwise we could be looking at some additional sell-off down to this level here. So we'll see as we're not the market's going to actually be able to base here. The other thing I'm going to point out is that our systems are short the market with a nice open position profit, but we did liquidate what had been a long position. So yes, we're up, but we did have to liquidate this one hedge position. So we were still up on the day, but it's not as big as this would normally suggest. Now, if you trade the S&P, the Dow, the Russell, the equities as a whole, what I'm going to do is I'm going to point out that as an ex-CTA, I believe in diversification. So this is our active systems. This is a breakdown for what the systems are actually doing as far as their profitability, and at least on the right hand side, and then the allocation within the individual portfolio. So you can see that we don't really have a lot of equities out there, but we have currencies and softs and grains. We've got a lot of different sectors that are involved, and when you're looking for diversification, this might be a good way to hedge yourself and protect yourself, because the portfolio did well, but unfortunately a lot of people are only trading the equities, and if you're just a one-trick pony within one particular market, no surprise that certain bad things can take place. So this will at least give you an idea as to what's taking place. If you want to see this allocation, you just come to a recent, and then down at the very bottom, active allocation. So all the way down here, and you can actually see this particular chart, and it'll give you an idea as to what kind of diversification we have for the active systems. The other thing I'll point out is that I did a webinar earlier today where we talked about grading the markets, and we went through all of the individual markets and show the process that we use to create these particular numbers. It was kind of intense and had to go through a lot of, not necessarily high-end math, but just kind of covered a lot of different details associated with how we create our grading type process. So if you're interested and understanding what these grades are about, so you feel comfortable that there's some thought that goes behind it, there's math that goes behind it. If you're so interested, just simply send me an email or something of that nature, and I'll send you a link to the particular presentation. It's an hour long, pretty straightforward, but I find this kind of stuff interesting, the way that we have to go through and run our calculations and what it is that we're looking for, so that we have the confidence to trade the markets. So when you say that a market is good or you say that it's bad, it's not subjective. There's math behind it. So if you're so inclined to understand some of the process that we go through, send me an email and say that you're looking for grading the markets, and that's the name of the presentation. And if you're interested, we'll send it to you, and then you can have a look. And from that standpoint, I guess we will take a look at some more markets. Expect increased volatility. I'll point out that we are pretty good with what happened with crude yesterday, and the basing that took place today, in the tiny little bounce we are looking for, and there wasn't the continuation. We'll see as to whether or not, with the major sell-off that we had today in the S&P, if there's any follow-through. But watch those support levels and look for the potential, just a potential, very early, but a bullish divergence that might pop up here. So with that, we'll take a look at another market tomorrow. Thanks so much. Bye-bye.